Welcome back to Wealth Path. In this video, we're focusing on bonds and fixed income investments. These options are ideal for investors looking for stability and predictable returns. We'll cover the basics of bonds, explore other types of fixed income investments, and discuss when they're best suited for your portfolio. Let's get started. Essentially, a bond is a loan you give to a government, corporation, or organization. When you buy a bond, you're lending money in exchange for periodic interest payments and, eventually, the return of your principal at maturity. Bonds generally offer an average return of around 2–5% annually for safer options like government bonds, while riskier corporate bonds can offer slightly higher rates. Because of these fixed interest rates, bonds are considered fixed income investments, providing a stable and predictable income stream. While bonds are a well-known type of fixed income investment, they're not the only option available. Here are a few other fixed income choices, along with typical annual returns. 1. Certificates of deposit, CDs, issued by banks. CDs offer a fixed interest rate, usually around 1–3% annually. They're low risk and often insured, making them a safe choice for conservative investors. 2. Treasury bills, T-bills, short-term securities from the U.S. government. T-bills yield 1–3% on average. They're very secure and provide steady income, ideal for those looking for a stable, short-term option. 3. Preferred stocks. While technically not bonds, preferred stocks can pay dividends with yields often around 4–7% annually. They're suitable for those looking for higher income without full exposure to stock market volatility. 4. Money market funds. These mutual funds invest in short-term, high-quality debt, typically returning 0.52%. When the Federal Reserve hikes the rate, the money market funds will also offer higher rates. When Fed lowers interest rate, the money market rates go down too. But your principal is always safe, unlike the money invested in stocks. Now, let's focus on major types of bonds and their typical returns. 1. Government bonds. U.S. Treasury bonds are considered the safest, with average annual returns of around 2–3%. This makes them a reliable choice for low-risk investors. 2. Municipal bonds. Municipal bonds, issued by local governments, offer tax advantages and usually yield around 2–4%. However, their safety depends on the financial health of the municipality. 3. Corporate bonds. Issued by companies, corporate bonds have higher returns, typically 3–8% depending on the credit rating of the company. High-yield or junk bonds can offer even higher returns but come with increased risk. 4. Savings bonds. Government-backed savings bonds offer a safe and stable return, often between 1–2%, though they're more suited for low-risk, low returns. Now, bond ratings and credit risk. Not all bonds carry the same level of risk. Bond ratings, issued by agencies like Moody's or Standard & Poor's, range from high to low, depending on the issuer's creditworthiness. Higher-rated bonds, like AAA-rated corporate bonds, tend to yield lower returns but are safer, while lower-rated or junk bonds can offer 8% or more but with greater risk. When to consider bonds and fixed income investments. Bonds and fixed income investments can be beneficial in various stages of your financial journey. Here are a few examples. 1. For stability and lower risk. Investments like government bonds and CDs offer lower but reliable returns, typically 2–3%, suitable for conservative investors. 2. For retirement income. Many retirees turn to bonds and preferred stocks, which provide steady interest payments. With typical returns of 2–7%, these investments help maintain income without high volatility. 3. As a portfolio diversifier. Fixed income investments can balance a stock-heavy portfolio by providing a buffer during market downturns, reducing overall portfolio risk. To wrap up, bonds and fixed income investments are valuable tools for building a stable, diversified portfolio. With returns typically ranging from 1–8% depending on risk level, they offer regular income and can help lower portfolio volatility. In our next video, we'll discuss mutual funds and ETFs, the pros and cons, and how to choose one. Don't forget to subscribe to WealthPath and hit the notification bell so you won't miss it. Thanks for watching.